Hello, everyone. I am Melissa Joy, and I'm so pleased to welcome you to the Winter 2023 Investment and Economic Outlook for Pearl Planning. And I'm thrilled to be joined by Melissa Fradenburg and Hannah Near today. Welcome to both of you. And I just had a quick housekeeping note that we are thrilled to be welcoming some new clients to Pearl Planning as we have a new financial advisor who is joining us as of this week. Yesterday was her first day with the firm, and her name is Tony Wander. So for the clients of Tony's who are listening to this as a replay, we just wanted to welcome you. And of course, welcome from the rest of the team who are here in this picture as we get started. There is so much for us to be talking about today. First of all, let's just recap 2022. You lived through a historic year as an investor, and I think it's really critical for us to take note and observe, how it was both in the markets and as a participant in the markets. Then we're going to talk about one of the most anticipated kind of moments in time, which is this recession everyone keeps talking about that hasn't quite come to fruition. Followed by inflation and the Federal Reserve. Then we're going to talk about stock markets and bond markets. Both of them were, great big stories in 2022, and we think will continue to be into 2023, but perhaps with some different outcomes. We'll talk about investment themes for this year. And then there is so much to be talking about outside of just kind of the economic environment, whether it's Secure Act 2.0, the looming debt ceiling, et cetera. So we'll mention a few of those things and some resources we have available to you, and we'll leave plenty of time for Q&A. So if you do have questions, you can put them into Q&A, and we're going to leave time for that at the end. But without further ado, why don't we dive in to what you need to pat yourself on the back if you've remained an investor through one of the most difficult years for investors, mainly so because we had a bad year in stocks and a bad year in bonds. And let's talk about how bad that year was. We often use charts like this to talk to you about what happens as an investor. We love this chart because it includes bars. If you look at the gray bars that are going across the straight screen, those bars are talking about how each calendar year ended going back to the early 80s. And then the red dot is the lowest point during the year. And in almost every single year, that red dot is a number that is more significant than where the bar ends up, and often by a significant amount. And so that is an important reminder for investors. First of all, if I told you that in almost any given year, there is an inter-year decline of 14%, you tell me, if I told you that was the average, you tell me, no, it's not. I don't remember that from year to year, because it's really easy to remember those times last year, but it's more difficult to remember how often they tend to occur. And so I think that's an important kind of framing and reminder for you as a long-term investing participant. But often, in many cases, more than 70% of the time, the stock market tends to end up. That is not the case for 2022, where we had declines as much as 25%. And in fact, the market was down right from the get-go in January throughout the entire year. You lived through a bear market as an investing participant, and the year ended up down 19% if you use the S&P to measure it. Meanwhile, most investors have some sort of mix between stocks and bonds. And, the age-old adage is that if you're a stock investor, you own bonds for those bad years. And that's typically true. Unfortunately, in 2022, especially because of inflation, which we'll be speaking about, there was a very strong and steady march up in terms of interest rates through the Federal Reserve decisions. And that means that, if you look at this picture and you say one of these bars is doing their own thing, 2022 was by far the worst loss in bonds, in this case being measured by the broadest US index, the Bloomberg US aggregate. At the end of the year, bonds were down 13% on average by using that index as a measure. And at the worst point in time, down 17%. And you can just see that in spite of bonds having negative intra-year declines, and certainly there are and have been years where bonds have been negative, this sort of event like last year is an outlier. And while it was very bad news for investors in 2022, it may change or has changed really our investing outlook for owners of bonds going forward. So there's very different equations when it comes to interest rates for bonds, et cetera. Now, how different was 2022 than any other year? Well, this is a look at, and it divides up in the northwest corner, you have the blue area is a great year or good year for stocks as well as a good year for bonds, which means they made money. And in the left-hand side at the top, you have years where bonds did well, but stocks were negative. And then in the lower right-hand side, you have years where in the gray area, you have years where stocks were good and bonds weren't good. Now, all of those have multiple dots in them. This is a look at almost 50 years of data. And in fact, I've been working in about half of those years. So I've lived through a lot of these different time periods, but none of them looked like 2022, where you had negative numbers for stocks and bonds, and not just a little negative, significantly negative. So about 70% of the time, both stocks and bonds go up. And then, 20% of the time you have one or the other going down. But 2022 was a very different year. Is that something you should expect every year? I really don't think so. I think that it is unique and it is likely to be a very rare occurrence, but we'll go through the numbers and give you a little bit of background as to why. It's not just because there's only one dot on the chart that looks like that. There's some reasons why. A lot of it starts with the economy, inflation, et cetera. So let's dive into some of that information. So despite declines in different indexes in the past year, there have been, when we look at what happens next after periods of decline, on average, it is likely that performance will be stronger going forward. First of all, let's look back at the previous year, and we look at different in the dark navy or black bars. You can see the 2022 returns, all negative for different types of stocks. So in this case, tech-heavy NASDAQ index was down about a third, 33%. And the next bar down 20% was small company stocks. Emerging markets were about the same as smaller company stocks, down about 20%. And then our kind of bellwether index for larger companies that many people are familiar with nowadays, the S&P 500, was down about 18%. This is unusual, at least for the last 10 or 15 years. International investments, in spite of everything going on around the world, in the Ukraine, et cetera, only down about 14% in the last year. And then the Dow, your kind of bellwether old school stocks, was down the least, about 7%. Looking forward, the average longer term returns, especially after a decline of more than 15%, tend to be higher than the average of all years. So forward looking, after a decline of 15% or more, and this is the chart on the right, you can see that the dark blue or black bar is the average return in 1 year for years with a larger decline, which it tends to be stronger than the returns on average in all years. Same for 3 years and same for 5 years. So that is not a forecast of exactly what's going to happen, but in terms of probabilities of what's happened in the past, this tends to be the case. And also kind of the return forecast for stocks tends to be higher when there's pessimism. And certainly we have quite a bit of that pessimism over the last year, with good reason, because what happens most recently is often the things that we remember the most as investors, whether you're a personal investor or professional investor. And so that pessimism is palpable. And, you can sum up that pessimism when you look at the headlines forecasting the great recession of 2023. Now we're giving you some information from Raymond James, the custodian that we choose to use in terms of how they see a potential recession going forward. The forecast for GDP taken from information around Wall Street is about 0% growth in gross domestic product, which is our measure of growth, and then an unemployment forecast that is higher than it currently is. Now, it's anybody's guess as to what actually happens, but this recession that everyone has been waiting for hasn't yet happened. We have very low unemployment rates still. We still have job growth and month-to-month returns. That has been muted more recently, but I can remember coming out of the Great Recession, adding 200,000 jobs to the payroll in any given month would have been fantastic news. And that's about where we are right now. So things have not fallen off a cliff there. And in fact, what we seem to be seeing is that there is several types of economies within the US economy. We talked about kind of K-shaped different outcomes for different sectors when we went into COVID times. And that kind of tandem of things being on different paths, one part of the economy being on a downturn while another is on an upturn, seems to be continuing. So some of the early pandemic winners are now in a softer patch. You can see in the kind of teal section, you have someone riding a Peloton in a class, and while Pelotons remain popular in my neck of the woods, not as many orders, and kind of that price for perfection moment isn't coming to fruition. And other examples that we see in our day-to-day are a bankruptcy with Bed Bath & Beyond, and other retailers that really thrived in a time where everybody was hanging out at home. Now we're kind of back to normal and a little bit different. It was impossible to get trucks to deliver goods during the height of the recession. And nowadays, the cost for shipping is lower and lower, and you have the availability to get things done, which just means that it's not as tight. You can't make as much money in those types of sectors. While streaming was very high leading into COVID and during the pandemic, the streaming of adult shows is much, much lower today. And then housing, which was priced for perfection, extremely high, also likely, if you think about it, bolstered by extraordinarily low interest rates, has had a change of winds where housing starts, housing sales, and pricing in many areas is changing significantly and slowing down. Meanwhile, services such as airlines, restaurants, energy, and healthcare still have a backlog, still have people ready to travel. Restaurant usage during the holidays was 15% higher than the year prior. Natural gas is selling at a higher price, and there's remains to be demand for healthcare, especially in areas that were elective, that were put off during COVID. So you see kind of a differentiation between different parts of the economy. While some parts are up, other parts are down. That's helping to mean that there isn't just one particular trend or direction in the economy. Another part of the economy, though, that has been an important growth story is savings and reserves because of fiscal stimulus, payments to consumers, as well as payments to business. So Americans came into 2022 with excess reserves. We've started to see those reserves tilt so that American savings rates have declined, as well as balances in savings accounts. So part of what has bolstered the economy, an extraordinarily strong consumer, is likely to be muting in terms of their demand. And we've had services which really fell off a cliff during COVID, which have recovered back to normal. And yet you see that the spending on goods on the right, in the lower darker line, has been above trend. So we expect that to come back down. All of this meaning that perhaps there will be a mild recession. And again, this isn't a prediction. This is just the information that we're seeing right now. And so we'll continue to be watching and seeing what happens in upcoming dates. Now, keep in mind, Hannah's going to be talking to you about stock performance as well as Melissa. And just because a recession starts at a certain point of time, which we know at some point there will be a recession, whether it's in 2023 or beyond, that is not always timed exactly with the stock market. So another huge story for 2022, and it had to do with everybody's returns, was the cost of capital as measured by the Fed funds rate. Interest rates rose at their fastest pace since the 1980s. They started near 0% in December of 2021, and the current Fed funds rate is north of 4% at 4.5%. Many people expect, many observers, market observers expect that these rates will continue to increase to at least 5%. Right now, the market is watching for a more muted raise, so that in many of these raises, they were at 0.5%, 50 basis points. And so even a more muted raise would indicate that there is better news out there. And you can see in the dotted line an expectation across the broader market of what's implied by the pricing of bonds, as well as the dark line is showing estimates from Raymond James, which would have a peak of interest rates in March of this year and have that remain stable through December of 2023. Who knows what happens again? This is not an area where forecasters are often exactly right. But what we can tell you is that a key indicator for this type of information is inflation. This is some more information about that Fed tightening cycle, and what you can see is how it's playing out in the economy. Borrowers are strongly penalized when interest rates go high as quickly as they have right now. It's a huge change in environment, while investors and perhaps savers are rewarded. So we went into the year, and this chart isn't on the page, but we went into the year for savers receiving nothing or almost nothing, pennies on the dollar, if you were receiving interest payments in a savings account. And now we're at a point in time with the Fed funds rate at north of 4.5%, where someone who's looking at a high yield money market can receive more than 4% for their savings without even having things tied up like CDs. Meanwhile, if you're a borrower, people who borrow money for their houses had extraordinarily low rates of payments for the amount that they borrowed. And those rates have increased significantly. You could have the average payment that you would have for a house over 30 years go up for the average American by 115% in the last over the last 3 years. So those are huge changes to the dynamics, and that is not just going to impact people in this year. It will impact them over time until interest rates are lower. Also, auto loans, an area of the economy where there were very few available inventory in automobiles for much of the COVID pandemic, now have their interest rates increasing sizably. So the average cost of a vehicle, if you have a loan payment, is $140 a month higher. That's a 23% higher average increase over the last years. And if you see those numbers in that auto loan chart in the middle of the page, these numbers are stunning to me in terms of the average car payment that people pay. They're in the $700 range, north of $700. So if you think about the average, if consumers have, in a double income household, have 2 vehicles, those are huge numbers and much, much higher than we were at 5 or 10 years ago. And finally, it's more expensive to borrow as a business owner. And that's likely not going to change for a sizable period of time. And so, of course, it's going to have an impact on the economy. Meanwhile, though, and it's important for economic observers and decision makers to keep an eye on information, because one of the main reasons that all of these interest rates have been increasing is in order to dampen and control inflation, primarily predicated upon the COVID pandemic and just disruptions all the way across the board. So you'll see that right now, the trend in terms of gasoline is lower. And in fact, the gas prices for right now are lower than they were on average 1 year ago. Used vehicle prices have been declining for the past 5 months in a consecutive manner. Same goes for appliances and clothing. When you look at the price of services, there are deals to be had right now when it comes to travel, something we just weren't seeing last year. And in food, there's also discounts and enticements when it comes to food outside the home. So trying to maintain that demand. One of the most persistent areas of inflation measurements, the one that we'll probably see relaxed the last, is shelter. So if you think about it, people renew their leases at least once a year, not more frequently. So we're not going to see the rents fall off from their higher numbers quite as quickly. And the same goes, the housing market, there's not as much supply, even though, even because people are concerned about, whether they can sell their house with interest rates being as high as they are. So shelter is going to be more persistent and longer. But across the board, even with shelter, we're seeing some relaxing of those very high inflation rates. All of these lead into our picture on stocks and bonds, which I think is a great time to hand it off. Hannah, you're going to talk next, right?
Yes. Thank you so much, Melissa. So I'm going to be walking you through some of the high-level patterns that we've seen in both the equity and the fixed income market to kind of hopefully provide you with a little bit more insight into where we've come from these past few years, and then also where we're potentially headed. So starting here with the equity market, and I feel like I've talked a lot about this this year with clients, but we really have to start with talking about the Fed and interest rate hikes. So a lot of analysts are starting to believe that the Fed is likely to kind of slow or end its interest rate hikes at some point this year. So if the Fed does move forward with ending its tightening cycle, it would be really, really good news for both the bond and equity markets. Of course, we're not trying to make any predictions there about what the Fed is going to do, but if they do decide to kind of slow their roll, that would be good news for the market overall. So on the left here, we can see that after the Fed's final interest rate hike historically, the equity market has tended to do really, really well over the 12 months that kind of follow that final interest rate hike. And then if we look to the right, we can see a similar effect on the bond market. After that final hike by the Fed, the 10-year Treasury moved lower for the next 12 months and kind of allowed for some really strong performance in the bond market. So, of course, everyone's kind of holding their breath to see what the Fed will do next, but we do expect them to kind of slow their roll in this new year. So we'll move on to the next slide here. And we're going to look at some of those patterns that I mentioned and kind of how they relate to our outlook on the market right now. So it's really unusual and rare to see back-to-back negative years in the S&P when we look back. So when we look all the way back to 1937 up until now, we've only ever seen back-to-back negative returns in the equity market 3 times. So it's always been in really extenuating circumstances that we've seen this happen. The first being World War II. Then we saw it again with the oil embargo back in the 70s. And then again, most recently in the early 2000s when we kind of saw the tech bubble pop. So we don't believe we're necessarily seeing such serious conditions to, in the current markets, I should say, to anticipate that type of same severity of back-to-back negative years. So of course, we're certainly not trying to make any predictions, but when we look at patterns from the past, that can kind of help us to feel a little bit more comfortable about remaining a long-term investor moving forward.
Oh, the price and earnings contraction is unusual to have it happen consecutively. Basically, what we've seen is the markets are getting cheaper right now. This is good for pricing looking forward. Of course, difficult medicine to swallow to get there. But as we look into the stock market for coming forward, we're building in opportunities for, kind of what's next. So let's say that we do have the anticipated recession. Again, typically the market tends to start recovering in advance of the end of a recession, not after the news that a recession is over. So it's typically not, you're not rewarded by waiting to find out that everything is kind of all good. And I like to remind people of that because it can feel, like you need some extra good signs when you feel like you're scared away from the market or tentative as an investor if you have cash on hand. But I really encourage people that oftentimes if you wait until after a recession, you can see on the chart on the left that, kind of yellow line, and you're just thinking, I just need to know that it's better. Well, then you perhaps find yourself at a point in time which is even better than the market was before the recession. And that doesn't feel like a good time to re-enter as well. So it can be very difficult when you're out of the market if you don't kind of make a game plan. When I'm talking to people, I encourage them to, why don't we dollar cost average? Why don't we put in a certain amount every month, regardless of what happens, so that you have a kind of decision rule or way to get back in. Also, the average performance for the stock market after peak inflation tends to be a higher percent of the time that it is positive. In fact, it's in the 90% range for time positive. That's the, if you look on the chart on the right, that's the scale on the right-hand side. And on average, returns are over a 12-month period of time, double digits. So, history is on our side if you're looking in the stock market for opportunities. Again, I don't want to give anybody in Washington, D.C. credit because they seem to, do more arguing than getting things done. But the third year in the presidential cycle tends to be, especially because the second year is a very difficult year historically on trend. The third year tends to be the best year in a presidential cycle, both in the first or second term of a president. So that's worth noting as well. And again, those lower kind of price earnings prices in the market tend to, then you start to have things get more expensive when it comes to stock, which you can translate that into stocks going up after you have inflation peaking. So, we're kind of revisiting some things that when it comes to inflation, especially, we haven't had to pull out this part of our toolkit as investors for many, many years. And so it is encouraging to revisit some of the trends that tend to happen when it comes to inflation. In fact, if you can get into inflationary times that are not out of control, you don't want to get into deflation. It tends to be kind of a Goldilocks kind of effect if you can get into 2.5% to 4% inflation. And, if we can have an inflection point where things start to come down, which we think we may be seeing, that should be positive. So fixed income, that's another word for bonds. I can't believe I'm saying this because it's been a long time, but I'm actually feeling very constructive for those of you who are bond investors, which are most of the people, but especially retirees, where you tend to have more of your portfolio, as bonds to moderate and provide some fixed income. Bonds start to recover before inflation signals that everything, kind of is over. And that's what we're starting to see in the markets right now. Not to say that, there's no bumps in the road along the way. But the first component of that is that now that interest rates have gone so much higher, you get paid a coupon to be a bond owner, which you were not being paid much of anything in the past. And that coupon can overcome even some hurdles of some remaining interest rate hikes. So that's important to remember. And looking at it from a 12-month period, after you have inflation peaking, almost 100% of the time, north of 85% of the time, bonds are higher. And, this is predicated on interest rates as well, but bonds tend to have a very strong period of time over 12 months and even better over a 2-year period. And then they continue to perform well, as that would indicate with that 2-year period, well after the Fed, kind of indicates by not raising rates. That's what we call a Fed pause. That really tends to help on the bond side of things as well. And it's not like you're trying to catch a fleeting moment in the sun. Bonds tend to continue to perform well over time. So we've just had this horrible year, the worst year when it comes to bonds since at least 1976. We're using the word at least because bond markets didn't trade the same way 50 years ago. And we have a completely new slate for bond investors starting this year. We initiated in terms of our investment portfolios mid 2022, and this may sound, against the grain, but we changed from an underweight that we've had in bonds throughout the time that we've had Pearl planning since 2018 to a very slight overweight in bonds. And again, you may think, why? But we know these trends. We know that the opportunity set is much different today, even if there's more defaults, even if companies come in, up against more things, there's just more opportunities, and you get paid to be an investor for those opportunities as well. So we really want you to understand that we are pricing in and looking forward. We're trying to look for opportunities, and I want Melissa, you can pick it up to talk about some of those opportunities as well.
Absolutely. So let's skip ahead to, well, I guess before I talk about the themes for this year, we'll talk about, again, higher quality, the opportunity in high quality bonds versus just because if we are, headed into a recession, you're not getting paid enough to go and take more risk in the bond area. So as far as opportunities there, we do like the higher quality, and you're getting, as Melissa mentioned, much better yield there, which can even make up for some potential sensitivity to additional interest rate hikes. So now we're back to the fun part, which is how do we invest from here, right? So we kind of rehashed what happened in 22 and the reason and the enormity of the anomaly there that we saw. How do we invest? Well, here are some of the themes that we are looking at, which the first one, actually, I'll go right to the next slide and talk about lower volatility, because that, while maybe not today in particular in the market, we do see 2023 being much less volatile. In fact, in 2022, we had 122 days of 1% daily moves. Now that includes up and down, but again, that is really hard for investors, for people that are watching the market, even long-term investors. It just tends to make people very nervous. So in fact, it was the most volatile year as far as 1% moves up and down since 2008. And as Melissa touched on as well, the 60-40 portfolio, which, typically those bonds do help, but it is in fact the most volatile year for a 60-40 portfolio since 1987. We do believe that 2023 is going to be less volatile. And on the next slide, I'm going to go over some of the reasons why we feel that way. We're going to look at economic risks, domestic risks, and global risks. And when we think about risks to the economy and things that we saw that really caused that volatility, the number one thing was inflation. And as Melissa pointed out in some of those slides, we are seeing that most likely inflation has peaked and a lot of those indicators are coming down. So that will be less of a cause for volatility this year. And then the most talked about and anticipated recession, if it does happen in 2023, most consensus is saying that it will be a mild recession, whereas at a point in time in last year, some of that volatility was over, again, how far the Fed is going to go, if they're going to go too far, and could we see, average or even above average recession. So we do think those risks are lower, which will lead to lower volatility. For better or for worse, we are living with COVID-19. So it is, I think we made a rule halfway through the year last year that we weren't going to talk about COVID in these economic updates anymore. We were just tired of it, but people are living with it. So we don't see that as a cause for volatility in the market going forward. US politics, as Melissa touched on, we are not in a midterm election year. Third year is usually a good time. We also have political gridlock. We do expect some headlines over the debt ceiling, but for the most part, not much is going to get done in Washington, which is good for volatility in the stock market. Now, when we look at global risks, the biggest factor last year for the market was the war in Ukraine. And while that's still going on, lower energy prices as well as less dependence on Russian oil should help that headline, again, cause less volatility in the market for this year. And lastly, China, their zero COVID policy really caused some of that volatility in the market and global supply chain issues. And we see that, at least as of now, we're looking at China reopening, and they're no longer having that zero COVID policy, which should not only reduce volatility, but can also increase growth for this year as well. So along the lines of China, another headline that you may see is talking about the end of globalization due to COVID and all the shipping supply stuff, on top of issues of intellectual property being stolen and other things. But what we're seeing as a theme for 2023 is just that globalization is changing. If you look at US imports of goods is actually up overall, but there has been a shift away from China and to places like Vietnam, Indonesia, and India. So you see headlines that Apple suppliers are pulling out of China, or American Airlines is moving their call center. Again, it's a shifting of globalization. We don't feel that this is the end of, or people are moving away from, and the numbers support that as well. So what does that mean? On the next slide here, when we look at themes or areas that we like, if you look at across the world, US-based companies are some of the most popular as far as brands. And if you look at consumer brands, you've got Netflix, that 47% is actually 47% of countries. Netflix is the #1 in consumer brands. Starbucks coffee chains, 73% of countries, Starbucks is the #1 retailer of coffee. This one was surprising to me, one, that it was KFC, but KFC is actually the #1 fast food chain in 43% of countries around the globe. For better or for worse, I'm not sure what this says about US companies, but all 5 of the top fast food chains are US companies. And again, with a global presence. And it should be no surprise that as far as smartphones, 72% of countries, Apple is the #1. But what this means as far as a theme that we believe will continue into this year is large cap US companies with a global presence should continue to do well. And again, globalization is not ending, it's just shifting. So we still continue to see this as a theme for 2023. Next, the idea of a shift back to fundamentals. If we look at historic bubbles bursting throughout the history of the market, for instance, .com crash back in the 90s, and then the mortgage-backed security collapse in 2008. The theme there with these sort of bubbles bursting is where you have prices for stocks that don't support fundamentals. So if we look at the next slide, we'll see kind of part of what happened in 2022 is you see meme stocks, right? If you followed that at all on Reddit, and Bitcoin down 64%. And then there were companies with negative earnings per share down 44%. We see this trend continuing on into 2023, which is quality, back to the fundamentals. So companies with strong balance sheets, with high earnings, and basically looking at stocks fundamentally that will outperform. We continue to see that trend, we believe, in 2023. What does that mean? Well, if you see the other kind of trend from 2022 that supports that would be a dispersion. So dispersion meaning a huge gap between the best and worst performers. And we saw that in sectors. So the best sector last year was energy, up 59%. The worst, communication services, down 40%. We also saw dispersion within sectors. So within industrials, you had building products down 22% and construction and engineering up 26%. Within consumer staples, again, personal products down 34%, food products up 14%. Even on the individual stock level, so within a sector like information technology, the graph on the right shows the difference between the best and worst performing stock in that area. A range of 149%, healthcare as well, 124% between the best and the worst performing stock within that sector. So the combination of companies with better fundamentals doing better, and then that huge dispersion both within sectors as well as at the individual stock level, we do believe to see the continued trend of active management being an outperformer. So if we look at the next slide, you'll actually see that 2022 was the first time since 2013 that active managers outperformed. And again, looking at these graphs just showing the reason for that was that dispersion between the best and worst performers, and then of course the fundamentals. So earnings per share on the graph on the left-hand side, that shows that companies who beat their estimates on the average 3-day performance following that reporting results were up 2.3%, while those that missed were down 6.8%. So it's going to be really important to, again, pick the winners within different categories. And so that theme of continued dispersion between winners and losers, as well as the idea that active management will likely outperform based on that dispersion, will continue this year as well. So where does that leave us? Well, you will also see there are some headlines, and people are saying because of that anomaly that we had last year with bonds being down as well as stocks being down, is this the end of the 60-40 portfolio or the blended portfolio? And my answer to that is no. And I want to show that one through this chart, because what this shows here, the green bars are stock performance, the blue bar is bond performance, and then the 50-50 portfolio is the gray bar. And you'll see what this shows here is the range of annual total returns going back to 1950. The bottom of this graph is in time periods. So nobody that is a client of Pearl Planning should be on a 1-year time period when it comes to investing, right? Because that is a very short time period, although we do spend a lot of time talking about 1-year returns, and even on this webinar. If we look, the range of returns on equities in a 1 year, you have a range from up 47% to down 39%. And that blended portfolio, even including the 1 year of 2022, really reduces that volatility, that downside that you experience there. But what I want to point out is on the 5-year rolling period, which is just to the right of the 1 year, that even with last year's negative bonds and stocks, you're still positive on a rolling 5-year going all the way back to 1950. So most investors with a long-term horizon are at least looking out 5 years. It improves more as you go out. So a 10-year rolling period and then a 20-year rolling period. That again, even factoring in last year, is, not going away. So if we look on a longer time period, that blended portfolio still makes sense. And just to point out the anomaly of that, the next slide actually shows just how rare that is, which I know Melissa touched on. So 2022 with the arrow on it all the way to the right, you see one, how rare it is for a 60-40 portfolio to be down 16% or more, looking back all the way to 1950. However, what makes it a little bit different is the gray bar shows just how much the fixed income downside added to that downside performance. So I want to point out that it is an anomaly, but also majority of the time that gray bar, the fixed income portion, is going to help buffer that downside when equities are down. And we still believe that that is a trend that is going to continue. And we still believe in that portfolio. And as Melissa mentioned, we're even more geeked about bonds this year than in past years. So The answer to that, or the last theme that I'm sharing for 2023, is that the blended portfolio is here to stay, and we continue to look at that as a good way to kind of buffer the downside for investors. And with that, I'm going to pass it back on to Melissa.
Thank you, Melissa. And Hannah's texting her apologies because her power went out. And all I can say is there's no need to apologize for acts of God. So Hannah sends her thoughts across the waves. And actually, that's one of the benefits of being in multiple locations. One of those things that we probably never would have had before, earlier in our careers. But I love the kind of hybrid office. But we've tried to focus on the historical impact of 2022. And again, I want you to pat yourself on the back, give yourself credit, and also take note of all the emotions and the emotional work it takes to be an investor in a bear market. Not to say that we know that the bear market is over, but it is important to remind yourself that being an investor, and even when you're not doing anything, you're remaining invested, can be very difficult, a lot of work, a lot of emotions wrapped up into it. And you've really lived through a big one. So give yourself some encouragement for getting through it. There is a new law that was passed in the last week, signed into legislation in the last week of the year, called Secure Act 2.0. It was actually in the omnibus spending plan, but it was focused on retirement preparedness, one of the few kind of bipartisan areas of agreement in Washington, D.C. And there were a bunch of little tweaks to retirement rules. Those tweaks include potentially making it easier to be contributing to Roth accounts, potentially making it easier to contribute more to retirement accounts in general. There was you could, if you had a 529 for a long time, you could potentially turn that money in, if it isn't spent for college, into Roth contributions. If you are a retiree, you won't have your retired minimum distributions start at 72. They'll now be starting at 73 or 75 if you have not already turned 72. So a bunch of different changes, and Melissa and I tackled this new law with many changes in a recent podcast. So we will make sure when we put up this recording to include a link to it. But if you go to our website and go to podcast, or go to podcast, you can look for episode 150 of 52 Pearls Weekly Money Wisdom, and we dive deep into the Secure Act 2.0. And we will be having webinars each month this year. And our next webinar is coming up on February 8th. And it's all about retirement readiness and retiring with confidence. So we would invite any of you to attend. We'll make sure that there's great information if you're mid-career, if you're near retirement, or if you're already retired. We'll make sure that we're talking about good habits for you too. And we love when you attend and share our information. I want to make sure that we include all our lovely disclosures. And again, the door is open for questions. And we also appreciate when you follow us on social media or interact there. And as always, when you contact us, you can find Melissa Fradenburg at melissa.fradenburg@pearlplan.com. And Melissa is in our Grosse Pointe office. I'm here in Dexter, along with Alexa Kane and newly Tony Wander. And then Hannah's up in Charlevoix. That's probably why she's losing the power, because they have different weather up there than we do down here. But I really think that there is so much happening right now. It's a time where, the career longevity of financial planning is really here to stay. And we really want, one of our missions is to keep our clients, our friends, and our community informed about what's going on, to help them feel more confident and less anxious when it comes to their money decisions, and to be there along the way with resilience, just like when the power goes out in one location, or you live through a bear market. That is part of what you sign up for as an investor. But we want to be a companion for you with both global and personal information. So whenever you have questions or you feel like it's time to reach out, please don't hesitate to contact us. And we appreciate you. I'm looking forward to 2023, whatever it brings. And great work on the presentation, Melissa.
Thank you. Yes, I'm looking forward to 2023 as well. And thank you everyone for joining us.